I love numbers. They weave a tale. And fantastic for giving me a minute back. So, the outcome, the demand, the request, and the tap dancing while they do the stage setup. Where I come from, as a Southern African, land is at the heart of things. We want big, expansive farms. We want urban title deeds. This flat thing is kind of new to us. But where does the money come from? I did love the triumvirate Sakina spoke on about capital, costs, and competitors. So let us see where East Africa stacks up in this era of turbulence. I'm going to invite up Andrew Ondimu, and he's going to have a panel that will converse on the fund manager's view. Over to you, Andrew.
In making investment decisions. Okay, a few more hands. This is quite a relevant topic because today we are going to sit with a panel of people whose day-to-day life is making these key investment decisions. And I know very few people raise their hands, but if you think about it, in every aspect of what we do, if you're in the real estate space, you're assisting somebody with their investment. If you're an architect, your design has a direct impact on how their capital behaves. If you're a property manager, you're managing the tenants. And this all waves in to what the property does in terms of an investment perspective. And this is the conversation we are having. So it's something relevant to all of us. And I'll just start. Good. Yes, so in the interest of time, I will let the panelists introduce themselves at the end, but I'll just start quick with Mr. Nanji, who with global markets as turbulent as they are, can a proactive, well-prepared seller still achieve a sale in this market, or should they wait? Yes.
Thanks, Andrew. Look, I think Sam touched on turbulence. I've been working in the industry not that long, since the 1990s, so it's only been a couple of cycles. Don't be deceived by the gray hair. Look, we've been through a lot, right? So when I started my career, I learned that things move in cycles, typically 8 to 10 years, right? And in those cycles, when you have a recession, asset prices collapse, and it's usually a very good time to start investing. So just in terms of some data points, like when the first crash that I went through was the dot-com bubble, it took us roughly 7 years to recover our money from the peak trough and then back to the peak. And then we had the great financial crisis, that took about 5 years, and then we had COVID. So these are the big three events over the last 15, 20 years. COVID, it actually took us roughly 6 months. And then going to the point of turbulence, over the last 5 years, it just seems like every day seems to be a bit of a challenge. So we've had a couple of wars, we've had, on top of that, we've also had, obviously, the Iran crisis, the potential impact on inflation and so on. But over that cycle, the main learning point from us was being invested is always a better idea than trying to time the cycle. And in terms of deals, look, there's a price for any deal, as long as it's a win-win deal for the buyers and the sellers, it makes a lot of sense. But obviously, timing does help. If there's a lot of capital coming into Africa looking at similar assets, obviously that drives interest. So timing does help. But again, I'll just go back to the point that if it's the right deal in the right structure and the right price, I think price is obviously very important, then deals can get done. Thanks, Andrew.
No, thank you. And you've touched on if there's a lot of institutional capital focusing on that asset class. And I think that's why I'll just bring in Ravi into the conversation. So from your opinion, where are people looking in, what asset classes are they looking to deploy in East Africa? And is that an asset class they're trying to avoid?
Thanks, Andrew, and morning, everybody. Pleasure to be back at the API. So look, Actis has invested all over the continent in real estate. We've invested in Morocco, in Cameroon, South Africa. And East Africa, it really sits at an interesting point on the opportunity curve. The East African market, sort of from a top perspective, it offers sort of fiscal and macro independency. We have, low dependency on commodities, high English proficiency. So it's a really interesting market to invest in. If you then drill down into sort of real estate, there's a lot of fundamentals that make real estate quite interesting in East Africa. I think if you just look at credit availability, if you look at sort of the delta between cost of borrowing and sort of unlevered yields, East Africa really does present itself as, across all sectors, a very interesting place to invest. I'd say that maybe let me start with sort of, some of the sectors that are more challenging. And I think, as Shritesh mentioned, from Actis's perspective, there's not one particular sector that I'd say we avoid or that we don't invest in. It all drills down into the fundamentals of, what the risk-reward metrics of the deal are, and what the asset has to offer. But if I really look at sort of what's interesting and what we like in East Africa, I'll start by looking at my friend Sam Kariuki. I think this market lacks scale, lacks institutional scale of real estate opportunities. And, companies like Mavida Homes offer that sort of correct risk-return reward. They offer investors a chance to sort of, scale up on an institutional level. And really the underlying demand in affordable housing is where we see a lot of opportunity.
Well, thank you for that. You've also mentioned just the deal parameters, and I think, Kesh, that really ties you into what you do. So specifically, what are the aspects of a deal that gets done, and how much is it promoter-led versus asset-led?
Sure. Thank you very much, Andrew, and good morning to the audience. I think, Andrew, to perhaps start off, it may be a bit of an oversimplification to attribute the relative success or failure of a deal to one single determinant. However, I think what we've certainly found within the deals that we've done, chiefly among which have been throughout Africa, particularly within the southern and to some extent East African market, is that the quality and credibility of the sponsor and promoter still ranks as one of the chief determinants of success in deal making. And let me give you a bit of perspective. So within the broader YW group, our core expertise lies in capital raising. So I speak from the perspective of having come from an organization where we've been involved in capital raising to the tune of over $12 billion US, deployed across 22 countries, but specifically within 9 African countries. The importance here is that there's a deal track record which we're leveraging. The one important aspect is throughout the deals that we have executed successfully, we've observed that people often forget that investors underwrite people and organizations before they underwrite the asset. And put simply, what this means is that you could have access to the best asset in the market. But at times, this may still be not enough if investors have lost confidence in the sponsor. And what are the perspectives that we need to take into account? Well, there's a couple of things. And anecdotally, what we've seen is that one needs to have a level of corporatization, if we call it that. And what does this mean? This means that have a level of governance which at least meets the standard, whether it's for a domestic or international market. Secondly, a level of track record. In fact, the corollary being that a questionable track record or questionable financial reporting is one of perhaps the biggest impediments to deal making. Of course, one has to have the correct locus standi. So in other words, have access and ownership or right of title to the opportunity. And it's interesting because what we have seen during the course of our tenure in the market is that investors can tolerate market volatility. I think Shritesh and Ravi had both attested to a couple of anecdotes. So investors can tolerate a level of capital markets volatility. They can tolerate things like construction risk. They can tolerate things like occupancy issues. And we've seen it again during the rise and fall of COVID, as well as other market cycles, as Shritesh had also mentioned. But what they struggle to tolerate is uncertainty. And this uncertainty arises from various perspectives. Misalignment, and this is misalignment in the investor-investee objective base, as well as on an ability to execute. Thanks, Andrew.
Thank you. I think whenever people get into the deal room, they think it's just about the asset, and it's really encouraging to see, or it's important to note that there are other factors, just the corporate governance of it all, the promoter and everything. I think you've given us a very detailed view of what investors are what deals are getting done and why. But you mentioned there's no one thing. Is there anything else on your checklist that you feel that people should make sure they have before they pick up the phone to call you or to call anybody to raise funds? Are there basic criteria, prerequisites, before we even start the journey?
Sure. Thank you very much, Andrew. I always say your first call should be to your advisor, and I say this in jest, but it is a serious consideration. And I think before approaching any institutional investor, or any investor for that mind, one needs to think like an investor yourself. What we found is that investors are not looking for perfection. What they're looking for is predictability. They're looking for certainty. They're looking for comfort. A clever way to actually think about this is the equity story. So you, as the asset owner, as the promoter, as the sponsor, as the portfolio manager, how do you posture yourself in the market? What is your equity story? What is that compelling value proposition that shows that this portfolio or this asset base, and to a great extent, the organization within which you speak for, commands a level of niche that captures the ear of the investor that you're chatting to? And this is a good way to entice appetite from an investor. Now, assuming one has hooked the investor, I would need to demonstrate that I myself am also institutionally like-minded. And what does this mean again? So to answer the question directly, Andrew, I think it's about having a clear corporate holding structure. In other words, no noise, making sure that you are investable in the eyes of the investor, that there's no further issues or detail that is creating uncertainty within the structure between the investor's equity investment and the asset. You need to have a level of demonstrable financial track record. And what does this mean? This means having in place at least a sense of audited financial statements for between 3 and 5 years, access to management accounts, and various other financial reports. Given that we're talking about property, the property relevant information also augurs well. This speaks to right of title. So ensuring that within the clear corporate holding structure, the fact that I'm reporting on an accounting or financial basis, I also need to ensure that the right of title, the leases, the rent rolls, the property valuation reports are all in place. All this information ought to be organized. And the thesis in being investor ready, or the litmus test in being investor ready, is, are you able to condense all of this information into a formal, shareable platform within a VDR within 48 hours? And if you can do that, then it shows that there's a level of readiness for that investor. I think the bottom line, however, is this. When we consider the African context, in particular, the context of African developers and property holders, on a, I think, lower to mid-market basis, some of the developers tend to approach capital raising emotionally. The point is that investors approach it systematically, and we need to be attuned with that system in order to speak the language, but also be successful in our capital raising endeavors. The point I'm making is that the moment one moves from this is my asset or this is my portfolio to this is an institutional investment product, the entire conversation changes.
Thank you for that detailed list. There are members of the audience. Do you feel that this is practical? Do you feel that this list makes sense? What I'll also ask everyone in the crowd is, in one way or another, you may hold property, even if it's just your own house or it's an investment that you're looking at. And even just given the list, you have to ask yourself, is the property investment ready? And that's something to really pause and think, because sometimes there's a temptation that after the first investment, you become a property man, you become a landlord, and you start treating it more like an ongoing asset. But you have to remember you were always first an investor, and that should guide whether you're reinvesting into your property. And I think one of the key things that always comes out, and I'll call Ravi into this conversation, is what is the right pricing for your asset? Because we've seen valuation reports that say one thing, but when you talk to an institutional investor, they'll come up with a number that's a little bit different. So Ravi, maybe just walk us through your arithmetic, and are you seeing a big gap between the valuation price and what you actually acquire it for, or what you can acquire it for?
It's a good question, Andrew. I'd say there's no magic formula when it comes to sort of valuation. A lot of it depends on sort of what your risk appetite is, what your sort of cost of capital expectations are. But look, typically, if we really simplify the arithmetic, as you asked, in real estate at a very entry level is sort of valued at, your sort of NOI, your net operating income, divided by your cap rate. Now, your cap rate is sort of your expectation of yield. Obviously, that formula really oversimplifies, the equation. It doesn't consider a lot of the more structural issues, capital structure, leverage, NOI assumes perpetuity of income. So there's lots of drawbacks to that formula. But I think, the right starting place before any type of sort of buyer, seller, any investor sits across the table from somebody else is to anchor your benchmark expectations on sort of your cap rate and your NOI. And then, the conversation can obviously build from there.
So to be clear, you're looking at it solely from an income position. It's more or less buying cash flows, really.
Yeah, what we've seen traditionally is a lot of people, especially less institutional investors, have the expectation that, hey, I bought land for this, I built this building, in 10 years' time, I'm going to do some of the parts, my land should be this, my building should be this. You can't unscramble an egg. Once you've cooked an egg, you have the egg, you have the cash flows. You can't, break it into some of the parts. So typically, at an institutional level, with scale, the real estate is typically, yes, it's an expectation of yield and cash flow.
Okay, perfect. No. And just for the non-investors in the room, so it's just your net operating income, so NOI, and then your cap rate is as close to, if you think of a government bond, just the return that you're making is what return do you want to make if these are the cash flows. So you're able to work backwards, but we can discuss more of that later. Right now, I just want to move to Nanji and just ask about what are the common misconceptions East African asset class owners have about institutional capital. I know you deal a lot with them, so what's the key misconceptions that they may have, and we can be able to demystify that today.
Yeah, sure, Andrew. I'll go back to my initial comments of a deal has to be win-win. Obviously, we all want better infrastructure, better buildings, better real estate. If I think of developments like Tilisi, I was going to save this till the end. I'm actually married to Rani, the famous Rani. So obviously, we want more Tilisi developments. We want more Samuel's developments in the country. But unless the deals are a win-win, which I mean, they need to make a decent return on capital and then sell that asset on to us. And going back to Ravi's comments, look, we're very simplistic. What yield are we going to get on acquisition, and how does that compare to our options? Again, from the intro speech, Sam mentioned look, there is capital, but it's, we have lots of options, and there's a lot of opportunity cost in deploying that capital. So unless we see, price is only one aspect of it, unless we see a decent price, it'll be very difficult for us to deploy capital in that asset class. So just in terms of what we've seen in the last 10 years, and we've been through a couple of wars, we've gone, inflation's gone from 1% to 10% in the US. We've seen a lot over the last 10 years. Our returns on our book in fixed income has been roughly 16%. On our offshore allocation, we've done 16% as well. And our local equities, we've done roughly 5%. So that's what we're looking at as our returns over the last 10 years. Obviously, we don't know what the next 10 years is going to bring, but given the volatility, the turbulence we spoke about, I think it's a reasonable assumption that we need to have returns of between 12 and 15% to keep our clients happy and our trustees happy as well. So that's the sort of benchmarks we're looking at. And I hope that helps.
Yes, that definitely helps. And just touching on, because you of course invested locally, you've invested regionally. Just from your experience, are you seeing the ease of business improving? Are you seeing the policy changes? And basically, what will you need to see in the market from the property level, the government level, and everything for you to deploy more capital into real estate?
Yeah, I mean, our business is mainly allocating capital in Kenya. We've got operations in Kenya, Uganda, Tanzania, and then we're part of a bigger group that allocates capital across Africa and globally as well. Ease of doing business. Look, for us, it's the simple math is what's the cost of capital in our markets, right? So when I look at capital markets in Kenya, obviously when we go through a lot of stress, we had yields of 15 to 18%, and that's pretty much our hurdle rate, unfortunately, which makes the ease of doing business and deploying capital for the developers very difficult. Because why would you invest in an asset that's going to potentially give you a lot of curveballs and headaches to develop, and it's long-term assets, when you can simply just buy a government security in that period. So that's the issue that we've got. So to unlock capital into real estate, we've seen a significant improvement in Kenya in terms of cost of capital. That's come down significantly over the last 18 months or 2 years. And that has resulted in more opportunities coming to our table in terms of where to deploy. So we've had lots of meetings with private equity guys. We've had lots of meetings with, obviously, real estate. And then we also have global offshore opportunities as well that's being shown to us as well.
Oh, thank you for that. I can see we are nearing our time. But Ravi, just while we still have you on stage, what we've seen increasingly diversified portfolios or investors looking for diversified portfolios. So how will you advise somebody to position themselves best for that?
Thanks, Andrew. I think if you'd like to sort of make the shortlist, let's say, for attracting international Pan-African capital, I think aside from returns, obviously, there's two main things that I'd say any sort of real estate developer, business owner would need to do to get onto that shortlist. I think the first, which both Shritesh and Keshav had touched on, is governance. And sort of I break that down into 4 buckets. I think the first is sort of clean financials, so track record, as Keshav mentioned, trustworthy financials. Number 2, it's governance. It's the right internal structures, the right governance setup, the right frameworks. Number 3, a little bit more outside of the control of sort of a business owner, but it's clean title. And number 4, it really falls down to management, and it's management's ability to speak institutional language, to be able to interact with an institutional investor on a day-to-day basis. So that's sort of the governance bucket. The second bucket, I'd say, is scale. And again, really for an institutional investor to deploy capital into these markets, what we look for is scale. A lot of the scale comes through M&A, it comes through acquisition. unfortunately, in this market, a lot of the real estate opportunity is quite fragmented. There's lots of great businesses, but fragmented, lack scale, or just wrapped in sort of in unstructured governance. I think if you can tackle those two avenues, you'll be a prime candidate for institutional international capital.
Thank you for that. And also just, I'll touch, Kesh, if you could also contribute to the conversation. Of course, you've structured several deals across the market. And who do you see is getting the capital? And is there a reason why? I'm just trying to paint a profile. Yeah.
Sure. Thank you, Andrew. I think my first statement would be is that one of the biggest mistakes we make as real estate stakeholders in the market is that assuming that all capital behaves the same way. I think Ravi and Shritesh have already given key anecdotes around the various sectors and geographies where we've seen persistent support from an investment perspective. I think if I were to draw it down to one thing, East Africa in particular is not capital constrained. I think it is investability constrained. And I think what may be of benefit to the audience is to flip the script a bit and maybe give you a bit of the topography of what the global capital markets look like, specifically focusing on who are the investors or what are the characteristics of the investors that have been putting capital into Africa. Take a moment just to picture the world map. We'll start on the top left-hand side, and what we've seen is that there is a level of support from the North American market, chief among which are among some of the institutions. So on an anecdotal basis, we've seen some interest from the Canadian pension funds, in particular the Ontario Teachers Pension Fund. In the US, in particular the Philadelphia State Pension Fund. Again, this is institutional-based equity or finance with an ESG type of mindset. And when we leverage the key takeaways from the earlier presenters, we find that it does speak to certain key sectors, industrial being one of them, affordable housing being another, and then data centers being a more preeminent strategy, finding strength and resilience of late. Moving across the Atlantic to the European market, I know Ravi can attest to this, but from the UK perspective and the Nordics, we're seeing again some support from the institutional capital markets there, chief among which are the DFIs, who are again very ESG minded in their investment mandate. Moving across to the Middle East, particularly here the sovereign wealth funds. It's imperative that given that there's such a significant asset base, all of this is underscored by one thing which Ravi touched on, and that is scale. So to attract the likes of the Middle Eastern investors, we need to be consolidating or looking at portfolios in excess of $1 billion. And that's significant. But it underscores the fact that within the context of Africa or East Africa as a region, there's still a significant sort of underpin for consolidation, at least to try and entice these capital markets investors who have traditionally looked at Africa but are looking for the opportunity to actually merit the investment. From an African perspective, I think the key takeaway here is that African investors are comfortable because they live here. So when we're considering pension funds like the Public Investment Corporation out of South Africa, who's got circa $25 billion to deploy across Africa, the family offices or the DFIs, there's a level of comfort and familiarity because we're investing in the markets in which we live in and traverse in. And lastly, to conclude, when we look at the Asian markets, this is the key anecdote, is we have seen a level of support and some interest from some of the Singaporean markets, whether it's some of the large institutions and to some extent, selectively, some of the Indian family offices that we deal with who are based in India, so names like the Tata Group, the Jindal Group, the Murugappa Group, who have at times expressed some level of interest in considering African opportunities, but on a very bespoke basis. So my key takeaway would be to actually take a moment to understand the investor universe, and align your equity story accordingly. Because like I said at the outset, we don't see the market as being capital constrained, but rather investability constrained.
Okay, thank you so much for that. Within a lot of takeaways, I'll just give a 1 minute outlook for each and every one of the panels, then we can close that. Yes. Ravi, we could start with you. Yeah, just summary. Can tell us what you do as well.
I think, look, the outlook for East Africa is very positive. It's been mentioned a number of times, right? Cost of funding, cost of capital has come down. The underlying consumer market is a lot stronger here. We've come out of a very turbulent sort of, divergence of monetary policy globally. Of course, as Shritesh mentioned, there's still a lot of geopolitical risk at the moment. But I think the outlook is really positive. A lot from a sort of funding capital markets perspective, looking very, very positive.
So the quick intro is we are part of Sanlam. We manage roughly $5 billion just in East Africa. For me, it'd be great to talk to everyone here. And Andrew, going back to your question, is it getting easier to do business, and is government an enabler for capital to come in? Because I think those go sort of hand in hand. And for any economy to do well, obviously you need the private sector to invest, and people like Raghav to obviously deliver on impressive projects. Thank you.
Thanks, Andrew. Just by way of short introduction, YW Capital is an international boutique advisory and asset management firm specializing on capital raising. I think the key takeaway here is that capital is the game. And if you are a family office or an institution thinking about either deal making, either on the capital raising side or looking for deal flow, or to fund the next phase of growth, then I would impress on you to reach out and establish contact, and then happy to have a conversation either after this panel or when the time permits.
Perfect. Thank you so much for your time. If nothing else, I hope from this panel you'll start looking at your portfolio more from an investor lens. I've been Andrew Ondimu. I'm a senior associate at CBRE Capital Markets. Happy to engage. Thank you.